Welcome to the Value Add Multifamily walkthrough. We're going to take a look at a particular deal in the Southeast Houston submarket. The way that I went about this one this time around was I went looking based on based on delinquent loan criteria. So certain data aggregators have an option to where you can look up properties based on delinquent loans, because that might be a sign that the operator's in distress. Maybe the bank is going to take the keys away soon, et cetera, et cetera. So it could be an opportunity to reach out to that owner and kind of see what's going on. Is there an opportunity here to either restructure, their equity and their investors' equity, to bring you in as a as a turnaround operator? Maybe they just want to sell outright, and get out of it. Might be a deep value add opportunity. So I went searching based on the following criteria. I wanted to look at multifamily properties that were somewhere between 50 and 150 units. The loan pay status, had some kind of delinquency aspect to it. And particular, I was looking in Houston this time. So after I went looking for a little bit, based on that criteria, come back here real quick. That particular search pulled up a few options. And I've been looking in Southeast Houston for a little bit. I've been looking in Pearland and League City and Texas City, Galveston, kind of this general area. Just it's been of interest. And one property that popped up was this Vista Del Rey property. So I went and I clicked through into it, and I took a look at kind of what's going on here. So the current owner, they bought it January 2017 for 3.65 million, about 40K a unit. Cap rate at that time was reported at an 8.2. This one is labeled as a two-star garden apartment in a suburban location, built in 1970. It's a Class C property, 92 units. It's wood framed, so nothing special about the construction. Parking ratio looks okay, might be a little underparked. But the more important information was kind of getting down into the loan information. So particularly around distressed properties, the owner just wants to get out of it. I mean, they would love to be able to, to make some money on the deal. That's why anyone gets into it. But oftentimes, they're just not able to make their debt service payments anymore, and they're just looking to get out from under it. So, origination balance here, was 2.65 million at the time of acquisition. Current balance is about 2.4 million. So we know that the loan has either started to amortize, or it was amortizing the whole length. Because it hasn't paid down that much, I would imagine that there was maybe some interest only here, and it looks like there was, right? There was this partial interest only period, and maybe it just recently started amortizing. So that higher amortizing payment might be stressful. Interest rate doesn't look like it was too bad originally. Shocker, they bought it in 2017 in a lower interest rate time. But the rate was variable. So likely that interest rate, has since gone up, and has continued to climb and make that debt service more onerous. Looks like this particular project, it's listed as market for rents, but we'll get into it here in a second. But a lot of the comps in the submarket are market and affordable, or they're all affordable, which means that they have some kind of like rent restriction imposed on them, either self-imposed by the owner to get some kind of tax credit, or imposed by the municipality. So this property might be a market rate apartment that's competing in an affordable area, which means that the valuation might be too high for the area, since the rents have to be lower to compete with the affordable product. Especially given the condition of the property. Just looking through a few pictures here. You got the outside of the property. It's nothing special. It looks like it's two-story. Nothing fancy. Looks like it's built in an affordable area. They've done some renovations to it. Maybe tried to match the style of the area. Painted exterior, painted doors, painted frames. Nice black iron railing. The leasing office probably could use some updates. And kind of clicking through here a little bit. The whole area could really use a facelift. The painting that has been done, it's a little out there. It's maybe tried to be attached to a brand or something, but it's It's not very attractive, so it could easily be redone, maybe improve the curb appeal of the property. This looks like one of the interiors of the units. I'd imagine this is an interior that hasn't been renovated, and if it has, there's probably some additional upgrades we could do, give it a more neutral paint color, better flooring, maybe put some laminate, vinyl planking in there, improve the lighting situation. Yeah, coming through, continuing to click through, looking at some more pictures. This unit looks nice. Again, the flooring isn't too bad. A cheaper option instead of replacing the flooring could be going through and steam pressing the flooring and regrouting to really bring out the the white lines in the flooring and make it look nice, make it steamed. Again, repainting a more neutral color. Nice open floor plan though. So right there's no real sign of functional obsolescence, no significant repositioning that needs to be done. It looks mainly cosmetic at this point. Going through, yeah, so like the walling in here, not a great job done on the background. The countertops are okay. This looks like more of a common area than anything, so we'd want to dig into that and see what this is. This looks like a closet that has been renovated. You can see that the grout lines have been done. It might come through and do a better cleaning job, but all in all, it's looking okay. And then you get into something like this, and it's like, okay, well, maybe some renovation has been done to this property, but we don't know to what extent yet. So that's good news that maybe some renovations have been done. All of this is starting to look good, but you've got like this popcorn walling going on in here, really cheap mirror and appliances. So some refinishes could be done, which is a cheap value add, but really meaningful. Has a big impact on rent premium. Continuing to go through again, popcorn walls and ceilings, easy to remediate. So yeah, this living situation here looks a lot better than the first one that we were looking at. So continuing the renovation plan and pushing forward might be a way to increase rents or to decrease operating expenses to really add value to the property. So again, yeah, it looks like this is one of those units that hasn't been done. Great. So we've gotten kind of a general idea of what this property looks like. Next, I would go and kind of get a broader idea of what the overall market looks like. Usually when I'm doing this process, I actually go the reverse way. And if I'm looking into a new market and a new submarket, I'm going to do some market research first. But today I was just looking in a market that I'm generally familiar with, the general MSA, and looking more on property criteria. And then I went and did market criteria, but usually I do the reverse. And the reverse can be really helpful because if I had done the reverse first, I probably would have looked at this particular market, Southeast Houston, where this property is, and I would have seen, you've got 1,300 units under construction as a percent of total inventory. So that percentage there, I had already done this before. So it's only 2% of units under construction as compared to existing inventory. So that tells me that the current construction pipeline is really low. So new deliveries coming in, not a ton. And probably the reason for that is developers have looked at this vacancy rate in the submarket and seen, okay, well, the market is probably oversupplied currently, so we're going to pull back on construction, and that makes sense. So you should see this vacancy rate, tick back down while the units under construction are low. But in the meantime, the market is currently oversupplied, so that's something to keep in mind. Coming into the actual market data itself, we go and we look at the data, and we see that the vacancy rate again, 12.8%, based on current market dynamics. So the supply and demand of the area, the rent growth has ticked down kind of quarter over quarter until where we're at right now to 1%. And that's due to the supply situation relative to absorption. You've had quite a bit of negative net absorption, meaning that there's been more deliveries to the area than the area could handle from a demand standpoint. So that's why you've had rent growth ticking down. Good to know. Going forward, CoStar in particular thinks that because of the lack of supply relative to the projected demand, they think that there's going to be increases in rent growth, and not anything crazy. It really tops out at 3%, but the average, over the next 5 years is about 2.25%. So kind of keeping pace with CPI inflation, fairly normal, fairly healthy. So good to know. The projected supply situation looks like it's going to level out relative to current supply and current vacancy rates. And so this market should return to equilibrium at some point in the future. But in the short term, we have to keep all of this information into account that we've learned, and not be really aggressive on rent growth, and keep the absorption question intact. So that would be kind of what I'm looking at the submarket level. Cap rate is also helpful. Seeing that the current cap rate is about 6.56. We could go into sales and take a broader look and see kind of what's going on here. Our particular asset is a 2-star asset, so we would discount what's going on here a little bit. But in particular, kind of the median looks like it's in the call it 150K a unit range for Houston broadly, and then Southeast Houston appears to be trading at a discount mostly to Houston, maybe in the 100K unit range, maybe slightly under. And then if we're looking at 2-star apartment units, which we are, maybe we're looking at the 75K unit range or something like that. So those are really broad stroke numbers. We'll get into particular numbers once we dig into the asset, but knowing sort of where our benchmarks should lie is helpful. These are sales volume, information sales volume in this market, just like every other market we're looking at. Has been pretty low with the capital market situation. So that kind of tells us, we need to be conservative, really conservative with our exit assumptions on the back end to make sure that our buyer pool is as broad as possible, so we have a good chance of actually achieving our exit. When you're in a market that has higher volume, you can get tighter on your cap rate assumptions because there's a broader buyer pool. But in limited buyer pool markets like this, you'd want to be more conservative than most. Market cap rate, yeah, again, like what we were looking at, looks like Southeast Houston about 6.56, so and 6.52 on the 3-star stuff. So maybe on our exit, the spread between 3-star and 5-star is about 50 bips. So maybe 3-star to 2 stars, another 50 bips. So maybe we want to start at like a 7 exit cap or somewhere around there. And CoStar again thinks that this exit cap rate is going to increase over the next little bit and then decrease going forward. But that assumption on the forward is really tied to the SOFR curve forward projections. Some of it has to do with supply and demand in the local market, and employment rates and projected rent growth and all that good stuff. But I would pay more attention to what's happened over the last little bit, what kind of the median has been, and then where we think we're going to be in the short term, and sort of benchmark off of that. So I would probably start my exit cap at around a 7 and increase it 5 to 10 basis points per year, just to give us some room to operate with. So that's kind of the analysis that I would do on the on the submarket level, and just kind of keeping that broader macroeconomic trend in focus of what's going on with interest rates, and then on the submarket level, what the sales volume in the area is, and because we know it's limited, we know we need to be conservative in our exit assumptions. So coming back to the property level, next what I would do is I would dump this information into my acquisition model. And so I've created an acquisition model that I really like. It's available for purchase on my website. It does a lot, but for the purposes of today, we're just going to walk it through a deal screening. So for this particular project, we're looking at the Vista Del Rey. It was built in 1970. From our information that we've looked at, we think around 2017 there was a partial renovation done. We'll dig into that more, after we've contacted the owner, if we think we're going to want to do that. The unit count. So I have an option in my model to drop in a rent roll to synthesize all the unit count. But for today, since we're just screening, we're just pulling off the high level information from CoStar. So I've pulled off the unit count and put that in here. I've pulled off how many of those units are occupied, the square footage, and the current rent of those particular projects, or of those particular floor plans. So we've got in-place rent of $11.33. So then what I would do is I would come in and I would probably start looking at my rent comps and my expense comps. And I want to look at rent comps because I want to see, is there room in this market to increase rents? And if there is, great. And if there's not, then is there another opportunity here? So I pulled in, several rent comps for the area. The the 3-star, and actually I need to change this to be 2-star because that's what it is, but we would want to renovate it to make it into a 3-star apartment community. So the 3-star comps in the area are really about equal to what the property is currently achieving, which makes sense. The owner's trying to increase rents as much as they can relative to the market, and they're really at market. There might be a little bit of room to bump there. So we assumed maybe a $25 rent bump after we've been able to do everything, but we're not going to get overly aggressive on this, especially in this type of submarket. So then I come down into my expense comps and I take a look at, so I've been able to pull 6 different properties in the submarket and pull their respective expenses. And the way that you do that from CoStar, you can do this on Yardi Matrix. You can do this on, I think RealPage has a broader option to do this. But on CoStar, you can come in, and again, with the loan financials, any property that has CMBS debt on it is going to be required to report their loan financials. And so you can come in and get a look at the property's financials if they have CMBS debt on them. So I'm going to come in here and I'm going to click into a property just to show you the general process of how I did this one. And you can see that this property has CMBS debt on it, so you can come into financials and you can look at the property's income statement and you can look at those per unit. And then you can see their operating expenses for the current period or for the most recent period. So you drop a few of those, into here, and then you get kind of an average of what's going on. This particular project had its expenses available, so you're able to see kind of how it's currently operating, and then you would see, how do I want to operate this property, or how do I think I'm going to operate it, and just sort of compare that. So, the way that I would operate this property, I'm probably actually going to add a little bit more to the expense load, but I'm going to do things in other income and the way that I'll work with the county on taxes and some of these other things. I think I can get the income to be a little bit more effective, expenses a little bit more effective in certain ways, less effective in other ways. But those quote unquote less effective things like landscaping or better unit turnover, better resident experience, I think that those are all going to lend themselves to better resident retention, a little bit higher rent, and just a better overall resident experience that translates into income. So after I've taken a look at all these expenses and then input my own operating expenses, I made some assumptions about where I think the income is going to be. Then I would take a look at where I think rent growth is going to be for the submarket, kind of like what we did before. Input those assumptions here, expense growth assumptions here. Going to separate out some expense growth assumptions for certain things like insurance and taxes, because those are always things that grow a little bit differently from the rest of the project. I'll input my debt assumptions. I won't go over like all of the technical things about the model because I've done that in the past on a separate video, so you can go check that out. But these are going to be like my general debt assumptions. I'm going to put some acquisition financing on it for the renovations that I'm going to do. I'll dig into what those are in a second, but I'm going to put some renovation financing on it. Then once all of those are done, I'm going to take those out with more permanent financing and then hold the project for a little bit longer. So after I've taken a look at some of these things, I should have the information that I need to make a valuation assumption. But first I'll show you some of the renovation assumptions that I'm going to make here before getting into the valuation. So looking at the project, there's probably going to be some HVAC needs here. Projects like this often have, like window AC units, or sometimes they don't have proper AC running through them. So that can be something, it's a little bit expensive, but running that through the property can be a great way to improve the resident experience. I've also included a reserve here for sewer piping in general, particularly with these older projects. Some of the underground systems can be old and rusted and either need to be completely replaced, which would probably be more expensive than this, or need significant renovations in order to make sure that they're code compliant, and that they're they're running the way that they should be. So I'm holding a reserve for that until I know a little bit more. On the capital costs interior side, so this would be like a broad stroke interior renovation. I'm just going to hold 10,000 a unit for right now, right? That's going to be simple things like painting, maybe replacing some flooring in some places, um, uh, just doing a variety of different things on the interior of the units to really improve that experience, like we had looked at the pictures before. So I'm going to spread that out, probably over a period of about 17 months, and then generate the rent premium associated with those renovations. For this particular market, there's not a lot of juice there, and that's really all we can assume. We can't push it more than is available to do. So, by now you've probably seen I have a purchase price in here of $2 million, and that's generating a 28 cap. So that kind of looks insane, right? Well, after you boil everything down that you need to do on this project, right? We're going to do some interior improvements. We're going to do some improvements to the building and exterior. We're going to hold some reserves to make sure that we're covered from an income perspective and a financing perspective. We have all of these soft costs that we have to deal with. We have some of these financing costs that we have to deal with. We have our fees. And all of that generates an effective cap rate of 11.25. So again, that seems like a lot, but when you're operating on, this Class C asset that, you're probably starting from like a 6 3/4 cap rate maybe today, and then you're trying to grow that 6 3/4 or 7, and you're trying to grow that by 5 to 10 basis points per year. By the end of year 7, when you get back to it, if you've only grown it by 5 basis points per year, you have a 7.1 cap at the end of it. But on Class C, like this could easily end up as an 8.5 cap, or it can end up as a 9 cap, right? So you need to have enough margin built into this project to really make it worth your while. All of that is to say, right, after we input all of this, we came to a valuation of $2 million. So if we go back and we look at this project originally, and I'll come back to it on CoStar just so you can see it. So we come back to it, right? The owner paid $3.65 million 7 years ago, and they originated debt of 2.65, and they still have debt of 2.4, and they've sunk their own renovation costs into this, right? So their basis is really probably like $4 million, or maybe 4.25 or 4.5 or something. So there's really no way that this owner is going to be willing to restructure at that valuation. So it's still theoretically worth the call to see if maybe CoStar got this information wrong, which is always possible, or they're so desperate that they're willing to recap and take a loss, et cetera, et cetera. But we've come to a valuation that at the end of the day, this should be able to deliver at least a 21% IRR over a 7-year period, and almost a 2x equity multiple to our investors over a 7-year period. And given the risk profile, and given the conversations that I've had with prospective investors, I think this is kind of what they would expect to see from a return profile, right? This is after Waterfall as well. So the project level returns are going to return about a 23, and then after the Waterfall, our investors are going to get a 21. So if you had a conversation with the owner and they said, yeah, I'd be willing to part with it for $2 million. I want to get out from under it. Or maybe they say, look, I can't do that. Maybe I can do $2.5 million, or maybe I can do more likely, right? You put in $4 million if that's really all that they can do. Well, that only generates sorry, it's reiterating here. That only generates a 6% IRR for our investors and a 1.3 equity multiple over 7 years. So that's not going to cut it. So then you could go in and say, look, I know that this doesn't apply to every project in every market, but in some markets, especially with affordable, we know that we're competing in a market that has affordability components. So maybe we could change this project from market to market affordable, and maybe we could deed restrict 20% of the units, and negotiate with the city to get a huge tax credit, or a tax abatement rather, that lowers our assessment ratio from 85%, down to 40%. And so that should theoretically, lower our forward taxes by about half, or about 40% or so. So if we do that, still at this valuation of $4 million, we're only getting to about a 10% IRR over a 7-year period, and for this risk profile, that's just not going to cut it. So maybe we go down to $3.5 million, and we reiterate our model, still only getting us to a 13%. Maybe you go down to $3 million, and that's getting us to a 16.5 with a 1.85. So that might be good enough. Might be good enough. Something like that, though, you would want to work with the current owner of the project, work with the city, get everything in writing, everything approved by an attorney, make sure that all of that is good and above board, and in writing before you go and close on the project, because now your whole business plan depends on that type of underwriting. But that's one way that, maybe the owner and their investors don't have to lose everything, but you and your investors are still getting a good enough deal, and you can create a win-win scenario there. So that's sort of how I would approach the screening of this type of project. Truthfully, if I went in originally and saw that the submarket was 13% vacant and rent growth looked pretty low, sales volume was really low or non-existent in this one, I would probably move on to another submarket before even going through the brain damage of screening. But I think that's one advantage that local operators and investors have in their particular markets is, people like me that live in Orlando. I'd look at this and I'd say, well, I'm going to pass because I'm not comfortable with that. But maybe they have some inside information that I just don't, and they can get a good deal on it, don't have to compete on it, and really generate great returns for them and their investors without a lot of competition. So yeah, thanks for joining for the screening. I'm glad to go through that process. I have a lot of fun doing it, and I know that my clients and customers find a lot of use in it. But that's our screening for today. If y'all have any questions, I'm more than happy to stay on or run through anything in particular, but that's all I have for you today.